Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's Recon Reports episode, we're doing a full tactical debrief on three covered call trades: XOM, SLB and Novo Nordisk. Two of these trades were built around ex-dividend dates, and one was a buy-right pure play that turned into a fast counterstrike. Together, these trades show three very different battlefield outcomes. One where early assignment happened exactly as expected, one where the setup worked almost perfectly, and one where a sharp overnight gap turned the trade into damage control. We're going to walk through each trade from the beginning, explain the setup, the execution, the management decisions, the close, the net outcomes, and most importantly, the lessons learned. The goal is not just to show you what happened, but to show you how to think through these trades. Let's start with XOM, because this trade was the cleanest example of a classic covered call around an ex-dividend date. The setup was built around the February 12th ex-dividend date, and the mission was simple: buy the stock, sell a call against it, and ideally exit through assignment. In my rules of engagement, the dividend is never the main objective. It's a small bonus, a little extra ground gained. The real goal is to capture some stock movement, collect premium, and let the trade play out in a controlled way. At the time, the energy sector was already moving in a healthy upward trend, so I was not fighting the tape. I wanted a stock that could keep grinding higher without any huge surprise moves in either direction. XOM was one of several energy names I was working with at the time. I also had similar trades in SLB, Petrobras, Kinder Morgan, Shell, and BP, but XOM was one of the cleaner setups around the dividend window. I entered the trade on January 30th by buying 100 shares of XOM at an average price of 140.08. Right after that, I sold the February 20th 142 call for 224 in premium. That was the initial covered call structure. It gave me a little cushion on the downside and a capped upside on the top side, which is exactly what I wanted for this kind of setup. Then, on Monday, the stock opened lower around 139 and kept drifting lower during the session. That gave me a chance to manage the position. I bought back the 142 call for a net gain of 95, and then I sold the February 20th 141 call for 155. That means I rolled down, but not out. I did not extend the expiration date. I simply moved the strike lower to collect more premium and keep the trade alive. By the end of that Monday, the stock was around 138. The next day, XOM rallied nicely and closed around 143. At that point, my short call was in the money, and rolling again would have meant taking a loss on the options leg without giving me a better overall outcome. Since I was already profitable on both the stock and the option side, I decided to let the trade play out. Because the call was in the money and the ex-dividend date was just a few days away, early assignment was a real possibility. In fact, it was more than a possibility. That is exactly what happened. I was assigned early on February 11th, which closed out the trade. Now let's look at the numbers. On the stock leg, I bought the shares for $14,008 and sold them through assignment for $14,100, which gave me 92 of profit. On the option side, I sold two calls and combined them into 250 of profit. That brought the total result before commissions to $342 of profit. Overall, this trade was successful and the execution followed my rules. Looking back, I could have maybe held the trade a bit longer and tried for another roll to capture more upside. But my philosophy is consistency. I prefer small, repeatable wins over trying to squeeze every last dollar out of a position. This is how you stay in the game long enough for the edge to matter. Next up is SLB, and this trade was very similar in structure but slightly different in outcome. Just like XOM, this one was built around an ex-dividend date, in this case February 11th. The main idea was the same: take a covered call style trade in the energy space, lean on the existing momentum, and let the position work in my favor over time. The operational plan was straightforward: buy the stock, sell the call, and ideally get assigned an expiration. If the dividend could be captured along the way, that was a bonus. I entered the trade on February 3rd by buying 100 shares at an average price of 48.50. At the same time, I sold the February 20th 49 call for 105 in premium. But I also added an extra layer. I sold a short put at the 46 strike for 42 in premium. That put was not the main event. It was a small side deployment, a way to collect a little extra premium while the trade was already in motion. Together, the call plus the put made this trade more like a covered strangle than a simple covered call. The stock then spent the next several days moving sideways without any dramatic breakouts or breakdowns. That was exactly the kind of environment I wanted: calm, controlled, and predictable enough to let the trade do its work. Because the price action stayed stable, I closed the short put on February 9th and locked in 29 of profit there. The same calm behavior carried into the ex-dividend date, which allowed me to collect the dividend as well. That dividend amounted to 29.50. With the put already closed and the dividend captured, I simply let the remaining trade continue into assignment. The short call eventually played out as planned on February 20th. Let's put the numbers together. On the stock leg, I made $50 of profit. On the short put, I made $29. On the dividend, I collected $29.50. On the short call, I kept the full 105 premium. Combined, that came out to $213.50 in profit before taxes and commissions. This trade worked well and did not require much management. It was one of those setups where the market basically stayed in the lane I expected it to stay in. As a trader, those are the kinds of trades you want more often than not. They are not flashy, but they are efficient. And efficiency is what keeps your account moving in the right direction. Now let's move to the Novo Nordisk. And this one is the trade that turned from steady progress into a quick exfil. If I had to describe this one in a single word, it would be counterstrike. It started like a controlled move, but then the market hit back hard and fast. The structure was the same as the previous trade, a covered strangle. The reason I entered the trade was a large gap down in the stock a few days earlier. My thinking was simple. After a drop like that, the stock might stay depressed for a week or two, or maybe even bounce back a bit. Either result could create a decent setup for premium collection. I bought 100 shares of Novo on February 6th at an average price of 46.75. Right after that, I sold the February 20th 48 call for 114 premium and the February 20th 43 put for 47 in premium. Again, the call was the main exit plan. My goal was to get a sign on that call and use it as the way out of the stock position. For a while, the trade looked good. The stock moved in my favor and I closed the put for 31 of profit. The price then continued to move sideways into expiration, which was exactly what I wanted. On expiration day, I decided to roll the call. I closed the original short call for a profit of 135 and rolled up and out by selling the March 6th 48 call for 142 of premium. That happened on Friday and I carried the position over the weekend. Then Monday, February 23rd, hit like a hammer. The stock opened almost 15% lower than the previous close. A huge gap down, and unfortunately for me, it was in the wrong direction. At that point, there was only one move left that matched my playbook. My hard exit rule is a 10% loss on a single position, and that line had been crossed. So I closed the call for a 133 profit and sold the stock for an $800 loss. That was the damage control move. Not ideal, but necessary. Now combine the numbers. The option side made me a total of $299 in profit. The stock side cost me $800. That means the trade ended with a combined loss of $501. This trade is a good reminder that the market does not ask for permission. It moves first and explains later. I was following my plan and the setup was valid when I entered. It worked until it didn't. I could not predict the gap and I'm not going to pretend otherwise. All I could do was limit the damage and get out. Could I have kept selling calls and tried to slowly recover the loss? Yes, maybe. But from a psychological point of view, I think it is often better to clean the board and reset. When a trade breaks badly enough, sometimes the best thing you can do is remove it from your mind and move on. Losses are a part of the game. The real skill is keeping them controlled so they do not wipe you out. Here are the main takeaways from these free trades. First, ex-dividend setups can work very well when the trend is already on your side. XOM and SLB both show how dividend timing can add a little extra edge without becoming the main reason for the trade. Second, covered calls give you structure, but they do not remove risk. XOM played cleanly, SLB was steady, and NVO showed how quickly a good setup can fail when the market gaps hard against you. Third, rolling can be useful, but it should always be based on the actual numbers. I rolled XOM once and NVO once, and in both cases, the decision had to make sense relative to the remaining risk and reward. Fourth, not every trade needs to be heroic. Sometimes the best result is a solid gain with no drama. Sometimes the best defense is a quick exit when the market proves you wrong. And finally, consistency matters more than trying to force perfection. This episode shows the full range: a win, a smoother win, and a controlled loss. That is what real trading looks like. And with that, we wrap up this episode of Recon Reports. We walked through 3 covered call trades, how they were structured, how they were managed, and what each one taught me about execution, assignment, and risk control. If you found value in this mission, be sure to lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.